September may be the month Wall Street dreads most, but today's numbers actually look pretty decent. It shows an economy that refuses to roll over. We got stocks hitting more records. GDP growth was revised higher, and the AI boom is showing up in real economic data. But we got a twist. Even as there's a ton to cheer about, the Fed faces one of its most important decisions yet, and we're going to talk about that here in a sec after we get through the markets update. So the S&P 500 rose 0.3% on the day, closing in on its 20th record high just this year. The Nasdaq gained 0.5% but missed another record, while the Dow Jones added 72 points, logging only its second record close of this year. But all records count, right? But what's driving all of this growth that we're seeing? Well, we just said one of the words. Growth is growing, risk and momentum strategies. All of those are pulling ahead and completely killing it. But the safe plays like dividends and low volatility stocks, those are what's lagging right now, unless you're Nvidia. In other words, investors are chasing the opportunity plays and not necessarily the defensive strategy. But the real story today came from Washington. We got some data. The Commerce Department revised its Q2 GDP growth up from 3.3% from 3%. So more growth than expected. That adds about $20 billion in annualized output in the US economy. And economists only expected 3.1%. So it's all good in the hood. The main driver here was strong consumer spending and a tech investment surge tied to artificial intelligence. Software investment is growing at the fastest pace since 2007. Wait, what happened in 2007 or in 2008? Companies are plowing cash into memory chips and data centers and intellectual property, and it's showing up in GDP. So like I said, it's all looking good. And even with tariffs hanging over trade, Americans are still spending on healthcare, pharma, travel, food. We love food. I love food a whole lot. One economist put it this way. It was real simple. The economy is chugging along despite volatility and low consumer confidence, and that is exactly what we're seeing. And this is one of these signs, of the clearest signs yet, that the AI boom is still intact. It's still going. It isn't just a stock story. It's bleeding into the real economy. Capital Economics noted the revisions show increasingly concrete signs of an AI-related boom in tech investment. That's why the S&P 500 surged this year, even while job growth is slowed. While there's all of these recession headlines, AI is becoming an economic engine and not just a market narrative. But here's the caution flag. We got to look at all of the different things to consider, and it is that September is one of the worst months historically for the stock market on average. On average, it delivers the weakest returns. Many assumed that the VIX, the volatility index, this is the Wall Street's fear gauge, explodes higher in September, but history says otherwise. Since 1990, so we're looking all the way back since then, September ranks only third for average VIX levels. October usually takes the crown for the most volatile month, with March being the second. So yes, volatility can rise in September, but it's not guaranteed. But just looking forward, usually, if according to this article right here on screen, and go look this up on MarketWatch, volatility begins to increase in September on average, and then even higher in October. And if you've been sticking along on this channel for any amount of time, we've been talking about those 2 months being the months a lot of economists, a lot of CEOs, a lot of Fed members expect some slowdown into the economy. Meanwhile, manufacturing data, let me put this on screen, in the central U.S. economy, central U.S. continues a fragile rebound. The Kansas City Fed's regional survey held a steady 1.0, marking 2 months in expansion after 3 years of contraction. Production is stabilizing, demand is creeping back up, but here's the rub. price pressures are rising, which we've been talking about these price pressures for quite a while. Manufacturers are paying more for raw materials and passing those costs on to consumers, so tariffs. And what that does is it complicates the September decision for the Federal Reserve. Yeah, a lot of people want them to cut, and they risk stoking those price pressures further if they do cut. So stagflation, like we've been talking about for a while, it's just like a broken record player. Everything I've been talking about lately, it's just what we've been talking about is just fulfilling itself in a way. It's like I was right or something. And then in other news on the jobs front, unemployment claims ticked lower. 229,000 new claims last week, down 5,000 claims. Oh, here, let me show up so y'all could see the title. And that fears just a little bit of a rising trend after a jump the prior week that we seen. Continuing claims also fell slightly. We're still at that 1.95 million mark, but the labor market is weakening, but not necessarily collapsing. Hiring has slowed dramatically. Only 35,000 jobs per month since May, yet layoffs remain pretty modest. So this is still that low hire, low fire economy that Powell keeps talking about. It's fragile, but one wrong move and it could flip, and it could flip fast. And this is why some Federal Reserve members are urging for cuts, like Fed Governor Christopher Waller. Chris Waller, my guy, gave perhaps the most forceful signal yet that we've seen. So in Miami, he had this speech and he was talking, and what he pretty much said is, let's go on with it. He's pushing for a quarter rate cut in September and more cuts over the next 3 to 6 months. Waller dismissed calls for a 50 basis point cut, but argued the Fed is falling behind the curve with tariffs pushing up inflation and jobs softening. Jobs softening. Remember, that is the words we needed to hear right there. Jobs softening. And he says the risks of waiting are too high. Now, what everybody's going to be watching next are all eyes on the data we're going to get tomorrow. So PCE, the personal consumption expenditures, the Fed's preferred inflation gauge, will be released. And what forecasts are calling for is 2.6% annual increase, with core PCE up 2.9%, and that would be the third straight monthly acceleration in inflation and the highest since February. If it comes in too hot, the Fed might only cut once, despite that speech we got in Miami from Chris Waller. But if it matches expectations or even a little bit lower, and even, it could come in hot, but not too hot, right? If it matches expectations or just kind of falls within that same little range, Powell has cover to start easing in September and green light for rate cuts. So the bottom line that we got, everybody, is that stocks are at record highs, new record highs after new record highs. The economy is stronger than expected. It's still chugging along. It's still showing resilience. The AI boom is real and feeding into GDP, and GDP is the main driver that we watch for to gauge whether or not we're going into a recession or not. And it seems like we're slipping further away from that narrative for now. But inflation, tariffs, and a softening labor market create a policy minefield for the Fed and the economy. September is shaping up to be a turning point, though. If the inflation report that we get for Friday confirms Powell's confidence, the Fed may begin its first rate cut cycle in over 2 years, but, 2 years. No, I think for just this year. But if inflation surprises to the upside, markets betting on 4 more cuts could be in for a shock. So what do you think, everybody? What's going on in y'all's minds? Will Powell deliver the rate cuts that a lot of people are so confident in, or is Wall Street about to get blindsided and completely shocked and the rug pulled up under them when we get a hotter than expected PCE report? Let me know down in the comments. But as always, return back for the daily market insights. We'll keep on talking about everything going on, and I'm happy to see you here, and I'll be back tomorrow, everybody. See you tomorrow.